Have you ever thought about, man, why is the financial system built the way it is? Why is trade built the way it is? Well, let me just tell you this. With everything even going on right now, the system is not broken. It was built this way. Everything that we're seeing. And my goal by the end of this video and all the videos to come is for my insight to just enlighten you, to gain more understanding of what is going on, the true impact of what is going on, and how to, which this is the main one, find opportunity in something that we can't change by just talking about how bad it is, or talking about how it should be like this, or talking about how it should be like that. All right, so I remember this one trade I took, right? It was like late August of last year. And it was prior to my entry, there was something that was coming out. It was a news folder called non-farm payrolls, which just basically tells us how many people got jobs. Tells us if the economy is doing well or if it's not doing well. So that was the first thing I neglected when I took this entry, right? Because I entered way prior to the folder coming out. Well, not way prior. It was probably about 30 to 40 minutes prior to that NFP non-farm payroll folder coming out that morning. And since I was trading USD JPY, that's a USD folder. So that was going to directly affect what I was trading. But the second thing I also neglected was the FOMC meeting minutes that came out later that day, just building a volatile momentum surrounding the market. So those were two things that I neglected. And with the more I know now about the impact of these fundamentals, even understanding that it's important to know if people got jobs and if that's good for the economy or not, there's opportunity in knowing that. Anyways, that trade I took, I ended up losing like $50 on that one trade. And I was probably trading somewhere with a $300 account, right? So, $50 of a $300 account, you're closing in on like 30% of that account, roughly 20% of that account. Just trying to do some quick math in my head right now. But like I said, that was in August of 2024 last year. So EHM trade, since I have glasses now, I've definitely brushed up on my risk management and my understanding of the fundamentals and how they are going to impact the day-to-day, the month-to-month, the week-to-week. And of course, everything is speculation, but my speculation is no different than anybody else's that I see on the internet. So I tend to just ride with my sentiment and use every opportunity that I take as a lesson to either learn or to profit, but there's always lesson in both. Today, we're going to talk about interest rates. Interest rates is something you're going to hear all the time throughout the entire year. Interest rates going up, interest rates going down, interest rates on your car, interest rates on your house, interest. What are interest rates? So in this video, I'm not going to dive too much into the specifics of what interest rates are, but the main point of this video, what I'm going to talk about today, is what I'm going to show you is how we can utilize the understanding of interest rates what I'm going to show you today in this video. What I'm going to show you today is if we can just understand how interest rates impact our daily lives and how that impact influences the candlesticks and charts. So I'm not going to dive into like the specifics and break down word for word what interest rates are, right? I'm going to give us a base understanding of what interest rates are. But the main point of this video of what I'm talking about is how just understanding what interest rates are and how they impact our daily lives, like things we know about, and how we can use that understanding and look at a chart and be able to make money from that understanding of how it's impacting the market just by interest rates, where interest rates come from, who sets them, why the people that set them change them. Because there are a certain amount of times in the year where the Federal Reserve is our central bank. Most countries have their own central bank. So our central bank for the United States is the Federal Reserve. Our Federal Reserve has the ability to do two things: drop our rates or raise our rates. Right. So it does one other thing, but that's one of the two things our Federal Reserve does, which we're going to talk about today. And so the Federal Reserve, throughout the course of the year, it's like 7 to 8 times they will come together and give essentially a press conference and come together to make a decision, because it's the Federal Reserve. It's not just one person. It's a board of members. I forget the exact number. I want to say like 12 maybe. But don't quote me on that. Just look it up and see how many members there are. The main member that is going to be making the announcements is Federal Jerome Powell, but he is not the only one making the decision. And so, like I said, throughout the course of the year, there'll be like 7 to 8 times where they're making that decision to raise the rates or decrease the rates. And based on what they do impacts the market. So it impacts the market after they make the decision, and everything leading up to the decision also impacts the market, right? So this is where the economic indicators or news folders come into play, because those are the breadcrumbs that gets left along the way based on what was said in a previous speech or a headline, right? And there's just breadcrumbs that get left along the way to the day of the interest rate announcement. The interest rate announcement happens. It then influences price again, but that influence is weighted, right? Because there was a sentiment prior. So if the influence of the market is in line with the sentiment, right, then people are going to be pretty happy. But if the influence the interest rate announcements had on the market was complete opposite of the sentiment, then the market's going to be, in shock or crashing, or, all the clickbait terms that I see all the time, every single day, right? And it's not like if we really just understand a little bit, right? Because it's not something you're just going to absorb at once. But the more you understand, the more you want to understand, right? And you can learn anything that you desire to learn. But I want to learn smart things and things that truly impact my life and things that I can benefit from in multiple different forms. And yes, understanding interest rates is a big one because it allows us to make money using candlesticks and charts. And so I'm just going to pick one example. One example I know of, I believe it was December 18th. The Fed made an interest rate change. I believe I took a trade on this day too. I was trying to find it on my trade locker prior to me recording this video, and I'm going to try to find it here again really quick, just because I want to take one quick look at it and make sure I don't miss it. But just to show you that I took a trade during this time, so it was something that is relatable, and it was a time during interest rates. So I just want to show you the interest rate announcement, where I find it, and then I want to show you the actual chart of the impact of it. And then we're going to put together two different perspectives. One perspective viewing it if we think the interest rates are going to impact the market in a bullish way. And then another perspective if we think that the interest rates are going to impact the market in a negative way. Then we're going to see how it impacts the market, right? And then we're going to loop it all around to how just understanding interest rates and how it impacts our lives and how that impacts the markets. And we're going to put all of that together. So let's really dive into it. All right, cool. I found it. It was September 18th. I said December 18th. It was September 18th that I'm going to show you an example of a trade that I took where all of this came into play. I've replayed the chart to before the interest rate came out. So if you know how the chart reacted on the asset we're going to look at, which is gold today, if you know how it reacted, then you already know how the market reacted that time. But for those of you that don't, we're going to, like I said, we're going to look at, so this is the interest rate decision right here, September 18th, 11 a.m. Arizona time, that is, and Fed interest rate decision. And we're going to look at the sentiment leading up to this. We're just going to touch on a few things, kind of understand how that may have influenced the Fed's decision. But then we're going to look to see the market reaction. But before we see the market reaction, I'm going to show you, or after we see the market reaction, I'm going to show you how what happened to me and why this is so important for us to know. Okay, so this is my FX book, right? This is my FX book. This is one resource you can use to see when the interest rates, first of all, come out. So if you go to the top of my FX book, there's a tab that literally says interest rates. And if you click on that, I always like to click on country just so it puts it in alphabetical order. It's from Z to A, but if you click it again, it goes from A to Z. But it shows what the current rate is, what the previous rate was, the change in the rate, the last meeting and the next meeting. So there's a way you could look at it there. What it won't really show, actually, I'm not going to say won't. Let's see if it does. If I click on, okay, so it'll just show all the news if we click on that. But I was looking for maybe a history of the interest rates, and maybe it does if I look for it another way, but I'm not going to do that right now. That is how you find it on my FX book, right? So interest rates, you can go and see by country the change, when the last meeting was, when the next meeting is, and then you can go from there. But the other way you can look for it as well, I like using this, is called the CME Fed Watch tool. Okay, the CME Fed Watch tool. Now what this is going to do, it's going to give you the countdown to when the next Fed meeting is to adjust these interest rates. It's going to show you the current rate, right? It's going to show you the percentage of a potential target rate for the next meet. And then it's going to show you just how the market's feeling about a change in the rate, right? And so this is what's important to look at from really from a day to day. Every time you pre-market session, this is something that you can touch and you can see how has the market shifted in terms of the sentiment, because this is essentially a sentiment on what the Fed might do. And anytime I say sentiment, because I'm going to refer to that term a lot, just think suspect, like something when you suspect something, suspect a particular outcome, or you forecast a particular outcome. I'm not going to say predict. Predict's a little bit different context that I don't want to get confused. But suspect, the other one I just used, just freaking completely lost it. But forecast, project is even a good one, I would say, that we can refer to when referring to sentiment, right? And so we can follow this one. So that's the CME Fed Watch tool. It also tells you at the top here, if that gets out the way, the top here, it tells you the next dates for the interest rate changes, even through 2026. So if you just think about the cyclical nature of the market, like there's interest rates that are going to fall throughout the year. And so for us to understand the fundamentals and the macros is so important, because it all comes back to the interest rates and to the Fed. Like it all comes back to that. It all comes back to that. It's honestly a beautiful puzzle. Once we know, it's kind of like a maze. When you're a kid, you do mazes. You go out to eat with the fam, and there's a maze and some crayons. And the best thing is when you're doing the maze and you find the way through the maze, and now the way in and out. Right? It's a similar concept here. Once we understand the maze of the macros, right? Once we understand the maze of the macros, we can know our way in and know our way out, to where we can know when to act on the opportunities presented and when to sit on the opportunities presented. So anyways, so my FX book is one way to do it. CME Fed Watch tool is another way to do it. And all I'm referring to is knowing when the interest rates come out. It's something that you can't avoid. Reuters will have it, but those are the two that I like to use. Specifically Forex Factory as well, which is just another news outlet. They'll have it on here as well. I've never looked to see if they have a particular portion for like interest rates like my FX book, but you'll be able to filter by USD, and if it's during that time or whatever pair you're looking for, you can even search for events. You can even search for events here. So if you go filter, put it on USD, that's what I mainly focus on. Search for events and go interest, Fed funds rate, that's fine. Boom. And it'll show you all the previous dates. And here we go. This is kind of what I want to see. See, my FX book doesn't have it like as clean as this, which, I can appreciate. You can go all the way back to literally 20. And this is the thing about data. Like I'm a big fan of it. You can literally go back to when the interest rates in 2007 were at 5.25, right? 5.25 base points, right? And see and really analyze and almost do a deep case study on what the market was like in 2007, and then to understand how we went from 5.25 base points, and then there was one meeting, later on that year, because this is the beginning of 2007, and then later on in October 2007, they cut the rates heavily, right? Like what was going, and then they cut them again, and 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 they cut, right? In 2008, we get into, there was some type of bubble during 2008, if I'm not mistaken, but we get into, like, we start really analyzing, oh man, and seeing what has happened historically, not to predict, but to understand the level of impact, and to analyze, and to, and understand the signals in which the market gives, because, just because we have historical data to go off of, doesn't mean it's going to happen the same way in the future, right? But we must use what has happened in the past and the cycle that is a pattern of the market, right? And of just everything involving it. There's a pattern, and we can use that to our advantage. And so this is Forex Factory. You can check the interest rates here. So that's where I find it, right? That's where I find the interest rates, right? So I just gave you 3 different ones: my FX book, the CME Fed Watch tool, and then Forex Factory. I will put these in the description so you guys have them quick and handy for you. So yeah, that's that part. And so now what I want to get into is the charts. Let's take a look at the charts. Okay, let's take a look at the charts. And so what you see on the chart here, we're looking at gold futures. Now, XAU USD and gold futures, not too far off. I'm gonna look at gold. Actually, for this example, we're gonna do XAU USD, because when I show you the trade that I took, it's going to be on XAU USD. Since then, I have changed for something else that we can get into in another video. But really loving the gold futures. I still have my live Forex account. That's never going anywhere, ever, 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 ever. But anyways, so we have XAU USD here. I've rewound this all the way before the Fed announces the interest rates, right? Whether they're going to cut or whether they're not. And so let me pull up the interest rates again. And so if we go back, we said September 18th, we're looking at 2024 right here. Look, right here, right? September 18th, 2024. The forecast, so what the market was projecting, this is what the market would have been heavily favoring on our CME Fed Watch tool. Right, so follow along with this part. The context is important, okay? And so this is the Fed Watch tool. This is not the exact date we're looking at, but this is just for context. So what the market under forecast on September 18th, where it says 5.25, how the market says 3.9% right now for it to change from 425 to 400 base points, right? That was at 96%, right? That was at 96% for the forecast, right? That's what the sentiment around the Fed on that CME Fed Watch tool was telling us something different that actually came about. Why is that important? It's important because everything is speculation. Until the actual data and announcement and decision and policy change comes out, everything is speculation. Are there heavier biases of what to be able to determine the potential outcome could be? Yes. But does that mean that every single time the forecast, the sentiment, the projection is going to be right? No, never, right? So we have to have that constant level of understanding the uncertainty, right? But how we can gather up just puzzle pieces, right? And put as much of the puzzle together as possible, right? So we have a clear picture of the overall big picture, right? And so that's the forecast. The forecast projected 5.25. So the forecast projected a cut, right? A 0.25 base point cut from the previous, okay? So let's talk about which we have a really good video. I think I'm pretty sure Q just did one and talked about interest rates. So I'm just going to talk about it briefly for a second, but then I'm going to encourage you to go watch that video, and I'll even tag it at the end of this video so you can find it easier. But the point is, interest rates, what determines cutting the interest rates? It's either to stimulate the economy or to not stimulate the economy. And so I like to refer to the gas analogy. This was always an easy one for me to understand. So just think of a gas in a car, right? So when the Fed is looking to cut the interest rates, they're looking to put gas in the car to fuel it so it can go. Right? When they are siphoning gas out of the car, they're looking to prevent it from going, right? The car, essentially. So they're trying to prevent overheating is a term you'll hear, but essentially trying to contract the market versus contributing to expansion of the market. Okay, so just remember that cutting interest rates equals the Fed is trying to encourage growth. Increasing interest rates, hiking interest rates, the Fed is trying to contract growth. Okay, that's the only context you need to be able to understand for this video. Okay, and so what does that mean for the market? Okay, what does that mean for the market? For simple context, what does that mean for the market? If you think about the interest rates going down allows more money to be printed. The more money that is printed, the less valuable each dollar becomes, right? And here I'm referring to US dollars. So when the interest rates are cut, this is going to have a negative impact on the dollar. This is not necessarily going to have a negative impact on the market as a whole, okay? It's just going to have a negative impact on the dollar, because there are other factors that we have to think about to consider to say, okay, cutting interest rates is going to have a negative impact on the market. Okay, does that make sense? But on paper, because you're printing more, now there's more money in supply, there's more money in circulation. By default, each dollar that is in circulation is going to be less valuable. So on the other side of that, when you make it harder for people to borrow, when you make it more expensive to borrow and decrease the amount of money that's being printed, right? Now you're increasing the value of each dollar in circulation. So that's what happens when the interest rates are hiked. So that is essentially good for the dollar, right? Because now it makes each dollar more valuable, right? And then you start seeing, influx into the bonds, to the U.S. bond market, because the interest rates influence the yields, right? And the returns that investors get by lending money to the U.S. through, and that's another topic we get into. But anyways, so remember what I just said, right? Remember what I just said about the gas in the car, what the Fed does, what it means, how it impacts, so that when we look at this example, we see that. And that's the other thing too. I talked about this. I think it was in the community. I can't remember where I talked about this, but I just talked about it recently. Oh, it was on our class yesterday. I talked about sentiment, right? And so the further off the actual result is from the forecast is going to impact how much it hits the market, right? So the further this number is, the actual number is from the forecast, right? So this is 5.25. So let's say, for example, from 5.25, the actual forecast was a 1%, right? That's 4% difference. That's significant in terms of what we're talking about right now with this economic indicator when it comes to the interest rates. So that would be a shock to the market. That would be a large surprise to the market. Okay, so it would completely hit the market, and you would see people freaking out, right? Both good and bad. And so a 5% off of 5.25, not super crazy. It's still a half a base point cut, but I wouldn't say this was like a major shock to the market, but this still impacted the market differently than if it would have come out at what the market projected or forecasted. Okay, so that's important. So but it's red because, like I said before,
This is a negative impact on the dollar because you're cutting interest rates, you're putting more in supply, you're making each dollar in supply less valuable. And so now we're going to look at the chart now that we have that understanding about how the folder came out. It came out at a 5%. The market previously projected a 5.25, but the market was previously at a 5.5. And so we were 0.25 less than the market expected, right? And zero point 0.5 less than the previous interest rate. Okay, so which was in July, so 2 months prior, a month and a half prior. Now let's go back to the chart. So now that we laid down the groundwork, and let me actually put it up here so we have it, right? So we have it, right? So the actual result was a 5%, right? The actual result was a 5%. The forecast was a 5.25%. The previous was a 5.5%. Okay, so why was the market looking to cut interest rates? Like, why did it already project that there was going to be a cut? So this was what, 2024? So in September, this is pre-Trump, right? But this is when he's, rolling into presidency, tariff talk. Like, there's all this uncertainty going on. Inflation's crazy. Like, things are unstable on a geopolitical level, right? And the U.S. is at the forefront of that, and markets are freaking out because Trump is about to get into office. They don't know how tariffs are going to impact the market. Our countries that are trade partners with us are freaking out. Like, you know what I'm saying? So if we think about all of that, that's all things that symbolize. And so, okay, so then we think back to the Fed, right? And so the Fed's looking at the data, right? They're analyzing the sentiment and whatnot too, but they're looking at the data. And during that time, which we didn't look, and for context, let's take a look. All we need to do is go to filter, and I have to do this. I was like, damn, I try to keep my videos short, right? But sometimes once I go down a few I have to give you guys the whole piece of the pie. Right, the whole piece of the pie. So let's just take CPI, because CPI measures inflation, right? And so let's go to CPI. Let's scroll down to 2024. Okay, so let's take a look at this, right? And so, man, I have to. We have to, Marcus. And so, okay, watch this, right? So let me pull up another tab. I'm gonna walk through this really fast, so you might have to pause it again and go through it. But it is important that I say it. But it's also important that you understand. I'm going to explain as best as I can. So please bear with me. Okay. And so we're paying attention to, I want us to pay attention to the interest rate announcement prior to this one. So prior to our September, it was this July 31st, 2024, right? And it was a standing streak of 1, 2, 3, 4, 5, 6, 7, 8, 9 interest rate announcements in a row where the interest rates did not change. Oh, actually, excuse me. So from it changed from 525 to 550 here. So 8 interest rates in a row. Almost a whole year goes by from September to July where the interest rates don't change, right? They don't change at all. Like I said, the Fed is going off the data. That's what encourages them, influences them, their decision to cut interest rates or increase the interest rates. And why does all this matter, Marcus? Why are you going in on interest rates? Because if we can understand how the market is projecting interest rates to be influenced, we can understand how to execute on the day-to-day opportunities. We can understand how to read the folders that come out on a day-to-day and their impacts on the market based on what the Fed is looking at to influence their decision to cut interest rates. There's so much value that comes from just understanding the interest rates, because it's not just an event that happens, July 31st, it didn't just happen that day and then it's done. Like, it's something that happens and then impacts the market the entire time until the next interest rate. So that's why I'm going in on these. But anyways, 8 interest rates in a row where we didn't get a change, right? The market, the Fed goes off of data, right? So I want to look at all the data that we got that July would be basing their decision off of, right? So July 31st. So we have to take everything prior to July 31st, okay? And so everything prior to July 31st, okay? So it was up and down. And so let's just take when it was good. So this was good for based on this folder. So this folder is CPI. So this is measuring the cost of goods, the cost of goods and services, the increase or the decrease of cost of goods and services, right? So when this number is green, that is good for the dollar, okay? And when the number is red, that is not good for the dollar, okay? I'm not going to go deep into why, because that's going to be another rabbit hole that somebody is going to have to come climb me out of. We're not going to go down there right now. But anyways, so we had 3 good folders in a row. Then it stayed neutral. Then a 4th good folder in a row. Okay. And so if we think about up to April, from December to April, right, there was 1, 2, 3 interest rate decisions that could have been made from December to April, right? And we stayed. We didn't hike and we didn't decrease. And the data was calm, right? Okay. And then we go into May, we get a decrease, a poor folder. We go into June, another decrease. We go into July. So 3 folders in a row where this is bad for the dollar, okay? And so now we're July 11th. We just got 3 folders in a row. So basically the whole quarter we just got back, right? And now the Fed gets to make their decision, right? And so they make the decision to hold rates. Okay. Why did they hold rates? Well, because the beginning of this year we were doing well, right? And then we kind of washed out everything we did. And I'm strictly just going off of the results here. Like, I can get deep into the nuances of how the data like can really impact. I feel like there's a number of different ways that it can, depending on the context. But I just don't want to get into that right now in this video. So I'm strictly just going off the folders and the results. And we pretty much have an even wash here all the way up until August. So we pretty much have an even wash here all the way up until July 11th, right? And then we go to the Fed funds rate. The next folder after July, September 18th, we get our cut, right? And so if we go back to this, September 11th, right? Nothing happened, right? Nothing happened. But since the previous months, we contracted, right? And then 2 months went by and nothing happened. This was the Fed looking to stimulate the economy. Okay, this was the Fed looking to stimulate the economy. And so we're going to go back to the chart now. And so we're going to see on the chart, this is gold, right? And so the gold, when the dollar, it's not as cookie cutter as I'm about to make it sound, because like I said, just like the CPI folder we're just looking at in interest rates, there's deeper nuances, but I'm just kind of giving base level. I'm giving surface level enough for you to understand the importance to learn this stuff, right? Study this stuff. And so when gold is going up and doing well, the dollar is essentially doing the opposite, right? And then when the dollar is doing well, gold is doing the opposite, right? And so based on that interest rate announcement, based on we touched on the macros a little bit, and just the pre-Trump era and how the markets were feeling and whatnot, what can we suspect about what's going to happen to gold on this interest rate announcement? When we already know that the market is projecting that we cut rates. So the market is already projecting we cut rates. So the market is already projecting to have a negative impact on the dollar. If we pair that with what I just said, a negative dollar means a positive gold. Okay, so what can we project if the market is already projecting a negative impact on the dollar? We can project on the release of this candle, the gold does well and gold goes up, right? Gold goes up. So, and what do we know about the folder that actually released? We know that it released even less than the market projected. So this should have even a greater negative impact on the dollar than the projection. So that means it should have even a more positive impact. I'm not gonna say negative and positive, but bearish versus bullish impact, a bullish impact on gold on its release, right? Because a bearish dollar is a bullish gold, and a bullish dollar is a bearish gold, right? And so we know the release. This is I'm gonna go on to the next candle. This is a 15-minute candle, okay? And let me actually look and see. We'll look at it together. We'll look at it together because I'm going to show you where I entered, and we're going to look at just the real. I'm going to give it to you real, right? And because I've traded this stuff before, and I will say I would trade it again. I would trade the interest rates again. I'll trade any news folder as long as my risk is proper. I've come far in that way. Like my analysis is proper. Like it's not any chasing that, everything psychologically is there. Like I'll trade anything. There's nothing that I'm going to say I'm staying out of the market because of X, Y, and Z, right? Because at the end of the day, everything is an opportunity, and every opportunity is a chance to gather data and that experience with my edge, with the market, with my analysis, and so on and so forth. But yeah, and so this next candle, watch this. Boom! Took off, right? Took off. Took off. And actually, I don't want you guys to see it, because no. So what I'm gonna tell you. So, and what do you think I did? What do you think I did? I took a buy. I took a buy. Now, back in September, I mean, I was very sound in my understanding of the macros even back in September. Not nearly as far as I've come to this point when I'm recording this video. I mean, it's just exponential growth from then. But I can't remember. I took a buy. I'm pretty sure I took a buy. We'll take a look at it, but I believe I took a buy on this, because that was, the point is, and we'll see it in a sec. But we see the market take off on this 15-minute candle, right? And just for context, how I would have entered this, it won't let me go back, but how I would have entered this. So I enter on the 5-minute, right? Just real quick, but this would be following my entry confirmations, right? I got price above this blue line, lagging line above price and the blue line. Like this is an entry, right? This would be my entry right here. Entry, we can just say that. Stop loss, the bottom of this lead span B, or the low. So we'll just say, just for this example, we'll say the low, right? And this is XAU USD. So you see that stop loss is at 200 pips, right? That's a lot of pips. Even the lead span B, that's a lot of pips, because there's so much volatility in the market and liquidity in the market at this time because of the interest rates, right? So this time was nuts. And so we're just like, we'll just say this is how it went. I wish I could show you on the 5-minute, but we'll use the 15-minute for example, because I don't remember my stop loss. I don't remember none of that, right? And so 15 minutes. So then next candle, what happens? Okay, we start moving up, next candle. Okay. And so we have to remember, like, that was the initial announcement that came out. So let's see what happened after the announcement. There's normally like a speech or something. Let's see if there it is, or if the market just was given the chance to react and respond. All right, so I'm going to go calendar. We're going to go to filter, none, USD. Boom. And I want to go to not this week. We want to go to May, or not May, excuse me, September. Because I want to see September 18th. Yeah, I want to see if there's anything else. Okay, so yeah. So the rates come out, but then there's a press conference 30 minutes later. So like they come out with the rates, economic projections, Fed statement, right? But then the Fed, and normally it's Fed Powell, is gonna get on that podium and they're gonna talk about the results, and they're just gonna talk about the market. This is when the Fed is getting on the podium at 11:30, right? And we're seeing correction already because this was the market reaction. This was the reaction. We want to respond. We don't want to react. I was so reactionary back in September, November, December. I was so reactionary, right? And that's that. We don't want to be reactionary. Just let me say that again. And so next candle, right? Next candle. And this is all while the speech is going on, and boom, right? So let me actually show you the trade I took. So this is a live account that I had, right? This is a live account that I had. I still have my live account. It's still going. Of course, I don't have any money in it. Why? Because I moved to Oanda, and this was with KOT Forex. I went to Oanda because it was more credible, more secure, more trustworthy, and I just wanted to make sure I was official. I don't need any shenanigans going on, with somebody trying to keep my money or whatever the case may be, and I get to trade on TradingView with Oanda, so like that is money. But anyways, this was one of the live accounts that I have. When we go to September 18th, right? September 18th, I lost $19.30. Now, I've always traded with somewhere between $100 and $300 account. Like that's kind of all I've said. This is all I need to grow, because at the end of the day, it's not about how much capital you have. Like I will sit and debate hardcore and win the debate with anybody who tells me it's about how much capital you have to trade to be profitable. It's not true at all. And so at this point, that's what I'm okay with putting in having to trade. And every time I get down and below that, I'll put some more in to get to that number to keep trading. And then, of course, I like funded accounts. I do like funded accounts, not on the Forex side. I like it on the future side because it has a little more credibility there. I hope Forex comes around to it eventually. But the capital is not the point. But the point I'm trying to make is I risked a large amount of my account, which that is not sustainable at all. And let's just say at this time, I don't remember, but it was a $200 account, right? So I'm risking almost 10% of my account on that one trade, and it was during the Fed interest rates. And I took a buy. So like my analysis on how the interest rates being cut would impact gold, right? Because I understood how it impacts the dollar, so I understood how it impacts gold. Like I understood both of those, right? So I took the right entry. I took two entries actually. Look, right? I took one here and one here. Both were at the same time, right? Literally a second after each other, right? So that was not only $20, but almost $30. So I almost risked 20% of my account, right, in one trade. Right, that's not sustainable. But the point is, right, I entered at 25.8766. So now let's go back to the chart. I'm at 25.8766, right? So let's put this 25.8766. That's where I entered. That's where I entered right there. Where did my exit come in? Let's take a look. My exit came in at One exit came in at 25.68 and 25.78. So exit came in at 25.68 and 25.78 because I had two trades in. Remember, 25.68, we'll just say that, and then 25.78. All right. So let's get rid of this. This was an exit. I exited one of my trades here on this line here, 25.78. And then I exited one on 25.68, which is this line here. On both of those, I was at a 0.10. I was at a 0.01 lot size, a micro lot. Okay, that's what I was trading right here on gold. And so my initial entry, my initial L, right, was 98 pips. That's why it was $9 and some change, because every pip when you're trading on gold, I'm sure there's other ones like this as well, but specifically gold's super clean about it. Every pip and if you're trading a point zero 0.01 or a point 0.1 or a standard lot, just a 1.0, every pip you can calculate. So in this case, on the point zero 0.01, every pip was like 10 cents or something like that, right? And so 98 pips, you slide the decimal over 98 pips, it's $9.80, right? If I was at a point 0.1, this would have been $98, right? If I was at just a flat 1.0, this would have been $981, right? But that's what I risked on that trade right there. Then my other trade exited right here, and I risked 196 pips. I can't even fathom that as a trader right now. Like, the fact that I was doing that is hilarious, because it has you just go through it. You go through making silly trades that way, right? You go through making silly trades that way because you get overconfident in your analysis. Because like I said, I took a buy. My analysis was correct, right? But I wasn't just trying to get this profit from my entry to the top of that. That's 111 pips, right? I wasn't trying to just get that profit though, because the same way we scale the losses, like I just mentioned with the 0.01, which is a micro lot, the 0.1, which is a mini lot, and the 1.0, which is a standard lot. I want to refer to those terms, and I hope you guys understand when I say mini lot, micro lot, and standard lot. It's just a lot easier than saying 0.01. Just so much wordage there. But yeah, so the same way we can scale that, like if this was a standard lot, that's $1,000 right there. You know what I'm saying? That's, $1,100 right there on a standard lot, right? Just off of that baby move. But I'm not trying to just get the baby move, not because I want a giant move, but because to me, if I was looking only to get that, like I'm just chasing, right? But I have a system, and I can't show you exactly how it lined up on this trade right now, because on the 5-minute chart, it doesn't let my chart go back to, this for some reason, which probably because I have to upgrade my subscription, which I'm not going to do. Don't need to do that. I'm good with what I have now. But we see that at that point is when I took that L on this trade. And so understanding what I mentioned about how the interest rates impact the dollar, how gold responds to it. We're gonna see how this ended up. Okay, we're gonna see how this ended up, because this is why it's important to not only understand the news, but to not react to it, but to respond, right? Because this was the reaction. This initial move was the reaction. Nothing even, like, we still had a whole major news folder coming out in 30 minutes, right? So this was the reaction. But since a news folder came out again here, now this is another reaction. The market hasn't responded yet, right? Because this is news right now is going on. 11:30, Fed Powell is talking at this moment. So the market reacted from the release of the Fed interest rates. The market reacted from the release of the press conference, right? And now, so let's see how the market responded. Okay. And so this is Wednesday, and now we're sitting on almost Friday. We're not there yet, but we see the reaction of the market and that proceeding, right? That proceeding through basically the entirety of New York. New York market ends at like 2, right? And so we see the market close right there on that candle, right? So to me, this price action with this candle and this candle, analyzing it now with what I understand and what I've had experience with when it comes to the market and the study that I've gone through, both of these are just reactions. Like, this is especially when we're thinking about it from a fundamental aspect. Like, I'm not even talking about anything technically related. I'm strictly talking about the fundamentals revealing themselves on the chart. This is just reaction. The market has not responded yet. Both of these price movements, the large movement up, because that's a lot of movement. From this bottom candle to that top candle is 304 pips. From that top candle to this bottom candle is 500 pips, right? So between 11 a.m. and 2 p.m., you're talking about almost 1,000 pips of movement. You know what I'm saying? Like on a standard lot, that's like 10K, right? Talking about 1,000 pips of movement. But anyways, maybe more than that, but I think I have my math right. But that's just for context, for how much movement that is in such a small amount of time, right? And so now we get in the market now gets a chance to respond, because I talked about this. I'm pretty sure I talked about it in the class, or it might have been my last video, or it might even been the beginning of this video. But I talked about I'm in Arizona, so in the evening in Arizona, it's a brand new trading day, even though it's the same day where I was previously trading, right? So like that morning, I was in the New York market of a separate trading day than that same evening when the market opens up again. So I hope that makes sense right there. So this is a brand new day for the market over here. Right. So now how I'm analyzing this is now the market gets a chance to respond. Right. The market's awake now. Like it reacted, market closed, right, into New York, market closed. Right. And now we're moving into Tokyo. Right. And this is gold. So we have there's foreign investors all the time coming in from gold. Gold gets a ton of money flowing into it from all different angles. Right. And so then we start to move upwards, right? We start to move upwards, right? So about 6 o'clock. So Tokyo opens at 5. This is daylight savings though before it, I think. So it might have been 6. Anyways, it's around here, right? But then we see the market just start to trend on up, and it moves up another 400 pips. But this is the market responding, because this is supporting the fundamentals, which is it has the most strength. But why it's showing up now is because it hasn't shown up yet, because all it did was react before. This initial move was the reaction. Like I hope we're getting that part. Like this initial move was the reaction because it was literally at the moment that it came out. So the market reacted in the moment. Boom. Right? The market has died. It's died down. Like it's gone up and down. And now this is it responding. But it's going up during this response because what actually happened supports gold moving upwards. Okay. And so let's just see throughout the end of the week, let's go all the way to Friday and see where this ended up following the announcement, right? This all started from Wednesday. This all started from one announcement, right? Really, well, we can say that just, you know what I'm saying, right? So literally this is Friday right here. Boom. This is where the market ended right here. Right? We'll just say the market ended right here. Somewhere right here. Boom. Right? This, and if we bring it back to the topic of this video, right? It has to do with the interest rates. And not only the interest rates, but being able to understand how they impact us. And not only being able to understand how they impact us, but being able to understand how we can execute on the opportunities that the market and the charts reveal to us and allow us to use based on the interest rates and based on the macros, right? And so from the beginning of this release of this folder at 11 o'clock, right, this is here. And from Friday, so in 2 days' time, right, if we would have not reacted to the initial move, because that's like I repeat things over and over again just so that nothing is misunderstood when I'm saying something. And so when, like, think about your alarm clock. Like when your alarm clock goes off at a certain time, right, you react and you turn it off, or you react and you put it on snooze, right? Because you're doing it in the moment, right? That's what happened right here. Reacted. This is like the alarm clock for the market. It reacted and bought. Right, but then we had another news folder with the Fed press conference, and the market Boom, alarm clock again. It reacted. And so whatever they said influenced the market that to do all this, to go down. So whatever they said didn't support safe haven gold. So that means it supported the dollar. So whatever the Fed was saying supported their strength or hawkish perspective, bullish perspective of the dollar. That's just speculation, right? But then we tanked down. But then the market reopened on the next trading day, later that evening, right? And this is when the buy began. And I can even pull up where I would have came in and entered this, even though this is the 15-minute chart, right? This is the 15-minute chart, but I would have came and entered this right around, based on my confirmations. And because we get fresh volume here on this MACD, fresh volume on this break, I'd take that. Right there. Stop loss below lead span B, right? Below lead span B here. Right? And let's just say we're taking it for a 2-to-1, even though it goes much further than that. But and we'll see where it ended up based on where I would have entered this based on my system. Now I enter on a 5-minute time frame, but the VXT system that we trade with, that it's literally, we have a whole class where we teach it for free. We show it for free. We go through lessons of every part of it, and it's literally available in our community, and that's what this is. But I enter that strategy on a 5-minute. It does work on a 15, but I like it the 5-minute. And so that would have been the entry there, right? And let's just see where this thing ended up come Friday, right? And actually, we would have gotten stopped out. Wait, pause that. Oh no, look, because we're going. So this is, I have to show it because you're like, man, wow, your trade got stopped out. So the exit of this trade would come when this white line breaks below lead span B, right? Me putting the stop loss here is to visualize my risk. So if it were to break there, I would have lost 108 pips, but it did not break. It held. It's not going off of price. It would only affect me if I physically put the stop loss in there, which for the sake of it, let's just say I did, right? Just so you guys know, I'm not here to BS or hide anything. Let's just say, boom, right there, we got that break in price, so it hit my stop loss. Okay, that's fine. Rewind. I would have waited for the same confirmation to come in, and we got it right there. Lagging line above price, above span B, buyer's volume. We're entering again. Stop loss at the span B there, go for a 2-to-1 again. And I would never risk 193 pips. I've definitely learned my lesson. I mean, even when I am trading with, millions of dollars, I still would never risk 193 pips. That makes no sense. But let's see. So I lost 108 pips based on how I enter my on trades and how I would have taken this. And so let's see what happens on this one. And this is all stemming from the interest rates and understanding the fundamentals, because I wouldn't be looking for sells in these moments, because I understand how the fundamentals and how the interest rates impact not only the market and the dollar, but gold and the pairs that I like to trade. And so you see, we got almost all the way up to this area, and now we're getting this correction. Let's see if we go hit that TP. Boom. So it ends up hitting the TP, right? So you lose 108 pips, but then you turn around and you gain 421. So, you're up 300 and, so what is that? Let me do that math real quick. 421 minus 108. So you're looking at 313, right? 313 pips that you profited, took a, and so that's why if you have the capital to withstand, and that's why XAUSD is a beast. I love you, XAUSD, but that's also why I traded on gold futures, because it's better for my current trading capital right now. But I definitely will be at a point where I'm able to maximize XAUSD, because these trades aren't nothing crazy. So let me retract my statement when I said I would never risk 193 pips, because this is on a 15-minute chart. This is already understanding the long-term movement of price, right? And so, but this is just an example. Like I can show this a similar example on USD JPY. And it won't be 193 pips. It will still be very volatile, but it won't be 193 pips. And I'll even show it real quick, just for the sake of this video. Watch 100. So yeah, it's already on here as well. April 18th, right? So April 18th, 11. Right, 11. We get this drop right here, this candle, right? Because we cut the interest rates. And this pair, USD JPY, USD is the primary currency. So whatever positively impacts USD, this pair goes up. Whatever negatively impacts USD, this pair goes down. So since the interest rates negatively impact USD, it went down initially, but then the press conference came out. We seen it march back up, right? And then we kind of seen it just continue to march up, but if we just take it, so let's see what ended up happening. Oh, that goes to Friday, and so we see it's a little bit different. Didn't give us as much movement, but even if we still take from when it turned around to the top of this movement, right, that's still 326 pips, right? So I just wanted to show that for the context of the volatility. But the point of this video was not entries. It was not strategy. It was not any of that. It was not how much you can make trading. It was not any of that. It was about showing how, and guys, if you're like, man, Marcus, that looked so complicated to be able to track this news and that percentage and this and that, it's a damn balloon away from me. If you thought that was confusing, just spend some time with it. I promise you, I felt the same way. Like, dude, like there's no way I'm going to be able to understand all this. And that's the thing. You don't have to understand all of it. You don't need to understand every little nuance and intricacy of the folders or the news or any part of trading. You don't have to understand it in every single bit. You don't. Just need to understand enough to understand how it impacts, influences, to be able to understand how you can maximize on the opportunity. Now, I will say there's a line between going too deep to where it's like wasted effort and to where you are putting yourself in a position to refine your edge. And so it does pay to know a little bit deeper about the fundamentals. But what I went over today, if you only focused on the interest rates, if you only focused on the interest rates and how they get impacted over time, over data, and how that impacts the market, right? You would be okay. I firmly believe that, because for you to understand how the interest rates get impacted, you have to understand the other news folders. And for you to understand the other news folders, you have to track those news folders. And for you to have to track those news folders and understand how they are impacting the market, you have to study a little bit on the specific news folders. So it's like the interest rates are just, it's going to lead you down to a few paths, but it's enough to where you can start putting the picture together. Okay? You can start putting the picture together. And so I know we went over a lot today, but to me, fundamentals, guys, is the most important thing we can understand with trading. Because once we understand the fundamentals, we can understand we can understand the trend of the fundamentals, right? And so that if we're ever trading against the fundamentals, we are aware of it. Not that we don't ever trade against them, because there will be opportunities presented there. And if you want to take it, that's fine. Just have proper risk and accept the fact that you are trading in a riskier territory because you are trading against the fundamentals, and the fundamentals are what move the market. So if you're trading against what moves the market, you have to be prepared and predefine and accept the risk that comes with trading against what moves the market. Okay? So that is really important for us to understand And so just understanding the macros allows me to not even take certain trades. It allows me to really sit and work on my patience. One of my rules is to not trade against the fundamentals. Do I make mistakes and do I still act against my rules sometimes? Yes, because I try to make excuses for, at least you know you're trading against them, just accept it, just accept it. But it's like, no, I don't want to trade against them. Right. And so then I take the trade and then it starts being all weird and choppy. And then I exit it because I feel guilty for going against my system, because there's just no point. There's no need for me to force entries and opportunities and chase. Like, there is absolutely, positively no need for that. Right. That honestly, it's one of those, two steps forward, one step forward, two steps back type of scenarios if we're approaching it that way. But I appreciate you guys for hanging out with me today. I really hope this video helps you and encourages you and inspires you to learn a little bit about the news. And even if you haven't traded before, like, it's a good way to warm you up to the markets, because all the charts are, guys, is just the revealing. It's the physical picture of the fundamental landscape. That's what the charts are. The candlesticks are just a physical picture of the fundamental landscape. So if you're reading the Reuters or in Wall Street Journal, and you're watching Bloomberg and you're just seeing how the market's talking and what it's focused on, you can kind of get an understanding of the temperature of the market, right? And like, when I say the temperature of the market, I'm referring to the sentiment. But you can kind of get an understanding of so the tech stocks are probably not doing as well right now, because the investors see those as more riskier stocks and more lucrative returns. And since the market doesn't have really much certainty right now, investors aren't really probably looking at those stocks. So I probably wouldn't put my money there. And now I'm referring to stocks, but it was just a simple analogy. You can do the same thing with the dollar. Like, there's so much instability when it comes to the dollar. Like, anything that has USD in it, a pair, Euro USD, GBP USD, that those pairs are probably going to do well, and those pairs are probably going to be bullish because they're going to be stronger than the dollar. And you could, I promise you, that's true, guys. You spend 10 minutes a day. If you've never even touched a chart before, you spend 10 minutes a day on Reuters and you just look at stuff related to the markets. I promise you, spend 10 minutes a day on that. Do that for 30 days. I promise you, you will be able to open the chart and have somewhat of an understanding of what is actually happening. Like, you don't need to know how to mark up your charts and use TradingView. I'm not even talking about that, but like, to be able to look at the candles and say, you can tell what happened on Monday because you just read something that on Monday, a new tariff announcement just came out. So on Monday there might have been some reaction from the dollar, and you're seeing that on the chart, and so that you can you know what I'm saying? Like, so like you could have more clarity viewing the chart. That's what the macros do for me. It's clarity. It's being able to see through the blurred lines and through the choppy, rangy price action, and being able to just focus on what's important and understand the cycles and the nature of the market. But appreciate you guys again for hanging out with me. If we made it this long, first of all, you're doing that for you, and I can appreciate that. What else I will appreciate is if you hit that subscribe button, hit the like button, share this with somebody that you love. Share this with somebody that has never traded before. Share this with somebody that has traded before. Share this with yourself so you can come back to it and watch it to figure out how I track certain fundamentals, how they show up on the chart. And just to get started, you can start tracking how interest rates have historically impacted price. Just by using the example we went over today, going to Forex Factory, you can literally start at any of those dates of interest rates, go back on your TradingView, or even just look up what was going on at those times for the interest rates to change and just understand why the change happened. If you even want a guide to do that, you put it in the comments, ask for one. We'll email you something. But there's just so much that I can say about the next steps for you when it comes to the fundamentals and the macros. But the point is, get started somewhere, gain understanding, because within that understanding, on the other side, we will find opportunity. EHM trades. I'm out. See you guys in the next video.